Have you ever looked at a company's financial reports and just, well, scratched your head? You see, maybe they've changed how they calculate inventory, or suddenly last year's profit number looks different, and you
Hmm.
start wondering, wait, can I even trust these figures?
Mm,
If they can just change the rules whenever they want?
exactly. And that feeling, that question about shifting realities, it really hits right at the core of
Mm,
investor trust.
yeah.
Because if companies could just chop and change how they report things or, hide
Then
mistakes,
comparing anything becomes impossible, right? Year on year or against competitors.
absolutely meaningless.
Yeah.
That lack of consistency, it doesn't just make comparison hard.
Yeah.
It basically destroys the reliability of the financial statements altogether.
Okay.
And that really is the critical job of IAS 8.
The standard we're diving into today.
Yep, accounting policies, changes in accounting estimates, and errors. Think of IAS 8 as the rule book, the referee, the quality control for financial reporting.
So it sets the rules for consistency.
Right, but crucially, it also dictates the very specific mandatory ways you have to deal with changes and corrections when they inevitably happen.
Got it. So, our mission today is really to unpack that single goal of IAS 8, making sure financial statements are consistent and comparable. Because that's the absolute bedrock of reliable reporting, isn't it?
It is the backbone, really.
And this deep dive feels especially crucial for anyone studying financial reporting. It seems like this is where you really prove you understand the why, not just memorizing definitions.
Absolutely. It forces you to grapple with the underlying principles.
Yeah.
And you've hit on the key challenge right there.
Which is?
That fundamental difference, the distinction that dictates whether you need to look backwards and essentially rewrite history, or if you just look forwards and apply change from today onwards.
Okay, so retrospective versus prospective.
Exactly. The biggest testable point, really, is getting that initial classification right. Are you dealing with a change in accounting policy? That usually means going back retrospective adjustment.
Right.
Or is it just tweaking an accounting estimate? That means looking forward, prospective adjustment. Get that wrong at the start.
And everything else falls apart. The calculation, the disclosure.
The whole thing. Your final numbers will be wrong. It's critical.
All right, well, let's jump right in then and lay that foundation. So, IAS 8 doesn't just exist on its own, does it? It's not some random list of rules.
Not at all. It's deeply connected to the big picture principles. Think of it as the enforcement mechanism for the IASB's conceptual framework.
Ah, okay, so it takes those high-level ideas from the framework.
And makes them practical, makes them mandatory. Specifically, it's all about enforcing those key qualitative characteristics that make financial information actually useful.
Right, the framework sets the goals, IAS 8 gives us the procedures.
You got it. And the first big one IAS 8 enforces is comparability.
Comparability. Being able to spot similarities and differences, right, between different companies like, I don't know, Coke and Pepsi.
Yep, that's comparing between entities and also comparing the same company over time, Coke's performance in 2023 versus 2024.
Makes sense.
Now, imagine if a company could just flip its inventory valuation method every year. FIFO one year, weighted average the next, back to FIFO, just depending on what makes their profits look better.
Comparability would be totally shot.
Instantly destroyed.
Yeah.
So IAS 8 puts really strict limits on when and how companies can change their accounting policies. It's all about protecting the integrity of that comparison, both over time and against peers.
So we're comparing apples with apples.
Exactly. Not apples with oranges, depending on the year.
Okay, comparability is one. What's the other key characteristic IAS 8 supports?
Faithful representation. This is absolutely fundamental.
Meaning the numbers actually reflect the economic reality.
Precisely. The information has to faithfully represent the substance of what it claims to show. And that means it needs to be complete, neutral, and crucially for IAS 8, free from material error.
Ah, so this is where errors come in.
Right. If we find out later that, say, we overstated inventory 2 years ago, then those original financial statements were not a faithful representation of reality.
They were wrong.
They were wrong. So IAS 8 mandates those retrospective adjustments, going back and fixing the historical record. It ensures those past statements, once you restate them, finally align with what actually happened. It's about restoring accuracy and neutrality.
Okay, so that's the why. It's about making the numbers trustworthy and comparable. Now, let's unpack the three distinct concepts IAS 8 covers. You mentioned getting the classification right is key.
Absolutely. The definitions drive the treatment. So pillar number 1, accounting policies.
What falls under this?
These are the specific principles, bases, conventions, rules, and practices a company chooses and applies when putting together its financial statements. It's the high-level methodology.
Like choosing the cost model versus the revaluation model for your big assets, your PPE.
Exactly. That's a perfect example. It's the company's fundamental approach to measuring and reporting certain items. The core philosophy, if you like.
Okay, the Constitution, as I thought earlier. Pillar 2, then. Accounting estimates. These sounded less fixed.
They are, and they have to be. Estimates are all about judgment. They use the best, most current information available to deal with all the uncertainties inherent in business.
Like what?
Well, think about it. No one knows exactly how long a machine will last, right? Or precisely how many customers won't pay their bills.
Okay, yeah.
So management has to estimate things like the useful life of an asset, or the likely cost of warranty claims, or how much to set aside for doubtful debts. It's their best informed guess based on what they know right now.
So policy is the rule book, estimate is the forecast using that rule book under current conditions.
Got it. And the third pillar, prior period errors. This one sounds like something went wrong.
It usually does. Errors are basically omissions or misstatements in past financial statements. The absolute key thing here is that they result from a failure to use or the misuse of reliable information that was actually available when those statements were first issued.
Ah, so the information was there, but it wasn't used correctly. Exactly. It's a historical mistake. Could be a math error, just overlooking something, applying a policy incorrectly. Note, that's a mistake in application. Not a change of policy, or, in some cases, even fraud. The point is, the right answer or the right method could have been known at the time, but wasn't applied properly.
Okay, so let's recap that distinction because it feels critical. Policy is a conscious choice of method. Estimate is a necessary judgment based on uncertainty and current info. Error is an unintentional, usually mistake, using information that was knowable in the past.
That's a great way to put it. Choice, judgment, or mistake. Nailing that down is the first step.
Right, let's focus on policies first. Before we even talk about changing them, how does a company pick a policy in the first place? For students, knowing that hierarchy must be important.
Crucial. IAS 8 lays out a very clear, strict hierarchy. Step 1, the absolute primary source, is mandatory. You must apply the specific IFRS standard that deals with the transaction or event.
So if it's revenue, you go to IFRS 15, leases, IFRS 16, no choice there.
No choice. That's the first port of call?
But, business is complex. New types of transactions pop up all the time. What if there isn't a specific standard that perfectly covers it?
Good question. That's where management judgment comes in, but it's not a free-for-all. If there's no specific standard, the company has to develop and apply a policy that results in information that is both relevant to users and reliable, meaning it's faithfully represented.
Okay, but how do they ensure it's relevant and reliable? Do they just decide?
No, IAS 8 guides that judgment. They have to look at other sources in a specific order. First, they look for requirements in other IFRS standards that deal with similar or related issues.
Trying to find the closest analogy within IFRS.
Exactly. And if that doesn't yield a clear answer, they then have to refer back to the fundamental definitions, the recognition criteria, and the measurement concepts laid out in the IASB's conceptual framework itself.
So they can't just invent something totally new. It has to be anchored in the existing IFRS principles.
Precisely. It maintains consistency even when dealing with novel situations.
Okay, that seems pretty rigorous for just selecting a policy. Given how fundamental they are, how often can a company actually change one? I imagine it's quite restricted.
Extremely restricted. To maintain stability and comparability, changes are only allowed in two specific circumstances.
Only two. Okay, what are they?
The first, and probably most common, is when a change is required by a new IFRS standard. When the IASB issues a new standard, like IFRS 9 for financial instruments a few years back, companies are forced to adopt it and change their policies accordingly.
And in that case, the new standard usually tells you how to handle the transition. Right.
Yes, exactly. The new standard itself will typically specify the transitional provisions, which often mandate retrospective application anyway, or sometimes offer specific reliefs. You just follow what the new standard says.
Okay, that's straightforward and a forced change. What's the second scenario? The one where management chooses to change a policy, a voluntary change.
A voluntary change is only permitted, and this is a very high bar, if the change results in the financial statements providing more relevant and reliable information about the effects of transactions on the entity's financial position, performance, or cash flows.
More relevant and reliable? That sounds tough to prove.
It is.
Yeah.
You can't just change a policy because the new one makes this year's profit look better, or because it's easier to administer or saves audit fees. You have to demonstrate objectively that the new policy provides a superior, more faithful representation of the company's economic reality than the old one did. It's a significant hurdle.
Okay, let's assume a company can meet that high hurdle. They've decided to voluntarily change a policy. This brings us to the core treatment under IAS 8, retrospective application. What does that actually mean conceptually?
Retrospective application means you apply the new accounting policy to comparative information for prior periods as if that policy had always been in use.
Always. Like you pretend the old policy never existed.
Exactly. You essentially rewrite the financial history presented in the comparative figures. It's the only way to achieve true comparability after the change. If you change your inventory valuation method in 2024, but you want users to compare 2024 fairly with 2023, then the 2023 numbers shown in the 2024 accounts must be restated as if the new method had been used back then too.
Okay, financial time travel, like we said. How do you actually do that? What are the mechanics for an exam or in practice?
Right, there are two key mechanical steps, and it all centers around the earliest period presented in the current set of financial statements. Let's say you're preparing the 2024 accounts and you're showing 2023 as the comparative year.
So we're focused on the numbers as they stood at the very beginning of 2023, which is the end of 2022.
Precisely. Step 1. You adjust the opening balances of any equity components affected for that earliest period presented.
Equity components, usually retained earnings.
Most often, yes. Because many policy changes impact profit eventually, like depreciation, inventory, revenue recognition, the cumulative effect of the policy change on all the years before your comparative period gets bundled up.
Okay.
So if the policy effectively changed back in, say, 2020, but you're only showing 2023 as a comparative in your 2024 accounts, the total impact on profits from 2020, 2021, and 2022 is calculated and adjusted directly against the retained earnings balance as at 1st January 2023.
I see. So that adjustment cleans up all the prior history before the comparative period starts. And this is where the statement of changes in equity, the SOCI, becomes really important, right?
Absolutely critical.
Yeah.
It's the primary place this adjustment is shown transparently. In the SOCI, specifically in the retained earnings column, you'll see it clearly laid out. You start with the line balance brought forward, as previously stated,
Old number.
the old number. Then you insert a specific line, something like adjustment for change in accounting policy,
Right.
showing the amount of that cumulative prior year impact.
Right.
And then you arrive at the balance brought forward, restated. This explicitly flags up to the user that the starting point for equity has been changed and why. It's mandatory disclosure.
Okay, so that's step 1. Adjust the opening balance of equity. What's step 2?
Step 2 is you must restate the comparative amounts themselves for each prior period presented.
So in our example, you'd actually change the numbers shown in the 2023 columns of the main statements.
Yes, you literally go back into the comparative column for 2023 in the statement of profit or loss, PL, and the statement of financial position, SFP, and you change those numbers to what they would have been if the new policy had been applied in 2023.
Okay.
This ensures that when a user looks across the SFP, the 2023 column is now directly comparable to the 2024 column because both are calculated using the same new policy.
That sounds intensive. Going back and recalculating past years. Now, what about the real world? What if a company's records from, say, 10 years ago when a policy might have hypothetically started are just gone or unreliable? Is there a way out of this historical rewrite?
That's a very practical point, and IAS 8 does acknowledge it. There's what's called the impracticability exemption.
Impracticability, okay.
Retrospective application is required, unless it's impracticable, to determine either the specific effects on each past period, the period-specific effects, or the total cumulative effect of the change.
And what does impracticable actually mean here? Is it just, this is really hard and annoying?
No, it's a much higher threshold than that. IAS 8 defines it as being unable to apply the requirement after making every reasonable effort to do so.
Every reasonable effort.
Yeah. It typically applies if, say, determining the effect would require making significant assumptions about what management's judgment would have been in the past under different circumstances, which is often impossible to know reliably. Or, more commonly, if the actual data needed to restate those prior periods simply isn't available anymore. Maybe it was destroyed or it was never collected in the required format and you can't reconstruct it reliably.
So if it genuinely is impractical to go all the way back,
Then the standard provides relief. If retrospective application is impracticable for a particular prior period or for periods before that, the entity applies the new policy prospectively from the start of the earliest period for which retrospective application is practicable.
Ah, okay. So you go back as far as you reasonably can.
Exactly. Maybe you can only reliably restate back to, say, 2021, even though the policy change conceptually goes back to 2018. In that case, you apply it retrospectively back to the start of 2021, adjust the opening 2021 balances, restate 2021 and 2022 comparatives if shown, and then apply it going forward.
And you'd have to explain why you couldn't go back further.
Absolutely.
Yeah.
You'd need robust disclosure in the notes explaining why full retrospective application was impracticable for the earlier periods. It maintains transparency while acknowledging practical limitations. It prevents perfect consistency from becoming the enemy of good, reliable reporting.
Okay, so policies are locked down pretty tight. Retrospective application is the default, unless truly impracticable. But businesses deal with uncertainty all the time. Where does the flexibility come in? That must be estimates, our second pillar.
Exactly. Financial statements are full of estimates simply because the future is uncertain. You have to make judgments.
We mentioned useful lives, residual values, bad debts.
Warranty provisions, obsolescence allowances, the fair value of some financial instruments. The list goes on. These rely on the best available information at the time the estimate is made. But circumstances change, or you get new information.
Right. Maybe a machine lasts longer than you thought, or a recession makes bad debts more likely.
Precisely. When that happens, you need to revise your estimate. And crucially, a change in estimate isn't seen as correcting a mistake in the past, nor is it a change in the fundamental principle or policy.
It's just updating your forecast.
That's a perfect way to think about it. You're refining your judgment based on new data or changed conditions. We don't go back and say the old estimate was wrong. It was the best guess then. We just make a better guess now.
Okay, this leads us right to that area you flagged as an exam hotspot. The critical difference between a change in estimate and a change in policy. Because sometimes that line can feel a bit fuzzy.
It's probably the single most tested conceptual point in IAS 8 because getting it wrong sends you down completely the wrong path for the accounting treatment.
So let's tackle the classic example you mentioned, changing the depreciation method, say, from straight line to reducing balance. My gut reaction might be changing a method sounds like changing a policy.
That's a very common reaction. But under IAS 8, changing the depreciation method is specifically classified as a change in an accounting estimate.
Okay, why? That feels counterintuitive. What's the logic?
It boils down to the substance of what you're estimating. Think about the overall policy for depreciation, which usually comes from IAS 16 on property, plant, and equipment. The policy, the principle, is that you must allocate the asset's cost systematically over its useful life.
Matching the expense to when the asset's benefits are used up.
Exactly. That's the unchanging principle. The method you choose, straight line, reducing balance, units of production, is simply management's best estimate of the pattern in which the asset's future economic benefits are expected to be consumed by the entity.
Ah, so if you think the machine will be used up evenly over time, your estimate of the pattern is straight line. If you think it's used up much faster in the early years.
Then your estimate of the pattern is reducing balance. So if you change the method, you're not changing the principle of depreciation. You're revising your estimate of how the economic benefits will flow. It's a judgment call about the physical reality of consumption.
Okay, that clicks. The method reflects the estimated pattern of benefit consumption, so changing the pattern estimate is an estimate change. What about changing the useful life itself, say from 10 years to 8 years?
Clearly an estimate change. You're just updating your prediction about how long the asset will physically last or be economically useful.
Right.
Same for changing the residual value estimate. It's all about refining future predictions.
Right. Now, to make that distinction really sharp, let's contrast it again with something that is definitely a policy change.
Okay. A clear policy change involves altering a fundamental recognition or measurement principle. Think about inventory valuation under IAS 2. IAS 2 allows you to choose between the FIFO, first in, first out, cost formula, and the weighted average cost formula.
Right, two different accepted methods.
If a company changes from using FIFO to using weighted average, that is a change in accounting policy. Why? Because they are changing the fundamental principle or basis used to measure the cost of goods sold and closing inventory. It's a choice between two distinct, permitted accounting rules, not just refining a judgment about an input like useful life or consumption pattern.
Got it. Policy is the fundamental rule choice, like FIFO versus WA. Estimate is the judgment applied within the rule, like useful life or depreciation pattern.
Okay, I think I've got my head around the distinction now. So if it is a change in estimate, how do we account for it? Not retrospectively, I assume.
Absolutely not. Since a change in estimate is all about incorporating new information or future expectations, we use prospective application,
Prospective meaning.
meaning you recognize the effect of the change only in the current period and, if it affects them, future periods. You do not go back and restate prior periods. You don't adjust opening balances.
Because the estimates made in prior periods were based on the best information available then. They weren't errors. There's nothing to correct in the past. The change only affects our view of today and tomorrow.
So the impact hits the profit or loss statement, but only starting now.
Correct. It affects the PL in the period of the change, and potentially future periods if the estimate impacts multiple years, like depreciation.
Can we walk through that useful life example again to see prospective application in action? Say the machine cost $100,000, 10-year initial estimate, straight line. After 3 years, the carrying amount is $70,000, 100K, $310. Now we realize it'll actually last another 10 years, not the remaining 7.
Okay, so at the start of year 4, the carrying amount is $70,000. The new estimate is that there are 10 years of useful life remaining.
Right.
With prospective application, you simply take the current carrying amount, $70,000, and depreciate it over the new remaining useful life, 10 years.
So the new annual depreciation charge is $70,000 divided by 10 years, which is $7,000 per year.
Exactly. That $7,000 depreciation charge is what gets recognized in the PL for year 4, year 5, and so on for the next 10 years, assuming no further changes in estimates.
And we don't touch the $10,000 depreciation charged in years 1, 2, and 3.
Absolutely not. Those figures remain unchanged in the historical records and any comparative figures presented. The past estimates were valid then. The new estimate applies only from year 4 onwards.
That makes practical sense, too. Constantly restating for every little estimate change would be chaotic.
Utter chaos. Prospective application is efficient. It reflects the reality that estimates evolve. It allows companies to update their numbers based on new information without the huge burden of rewriting history every time a forecast changes slightly.
Okay, that covers policies, usually retrospective, and estimates, always prospective. Let's move to the third pillar, prior period errors. We define these as mistakes, omissions, misstatements from misusing information that was available back then. Could be math errors, oversights, misapplying policies, even fraud. What's the treatment when we find one of these?
Right. If an error discovered relates to a prior period, and it's material meaning it's significant enough that it could potentially influence the decisions of someone reading the accounts,
Then it needs fixing, obviously, but how?
it demands the most rigorous approach. We bring back the time machine. Material prior period errors must be corrected retrospectively.
Retrospectively, so the same treatment as a voluntary change in accounting policy.
Exactly the same treatment. You restate the comparative figures, and you adjust the opening balance of retained earnings for the earliest period presented.
Why the same heavy-duty treatment for both a deliberate policy change and an accidental error?
Because the underlying objective is identical, to ensure faithful representation and comparability. In both situations, the historical financial information previously presented to users was, well, wrong or misleading. With a policy change, it was wrong according to the new superior policy. With an error, it was just plain wrong because of a mistake. Either way, the historical record needs to be corrected so that the comparative figures are reliable and actually comparable to the current period's numbers.
Right, you need to fix the baseline. Let's get practical again. Can we walk through the mechanics using those exam-style scenarios?
Wow.
That fraudulent receivables write-off example sounded like a good test case.
Yeah, the Dodgy Co. example's perfect. They discover a $3.4 million overstatement of profit over several years because trade receivables that should have been written off as bad debts weren't due to fraud. Now, the first step is crucial. You have to dissect that total $3.4 million based on when the error actually originated.
Okay. Let's say the investigation shows $1.0 million. That relates to dodgy sales made and receivables generated in the current year, 2024. And the remaining $2.4 million relates to sales made in previous years, say 2023 and earlier.
Right. Now, how do we treat each piece? The $1.0 million that relates to the current year.
That's not a prior period error, is it? It's an error discovered this year relating to this year's transactions.
Exactly. It's simply a correction within the current accounting period. It represents an expense, bad debt expense or similar write-off, that should have been recognized in 2024 anyway. So that $1.0 million is recognized as an expense in the current period statement of profit or loss for 2024.
Okay, straightforward. It hits this year's PL like any normal expense discovered during the year-end process.
Correct. It reduces the 2024 profit. But now what about the $2.4 million? That relates to sales and profits incorrectly recognized in previous years.
Which means the profits reported back then were too high, and the opening retained earnings figure we brought into 2024 was also overstated by $2.4 million.
Precisely. That $2.4 million is the genuine prior period error. And because it relates to history, it needs retrospective treatment. Critically, it bypasses the current year's 2024 profit or loss statement entirely.
It doesn't get treated as a 2024 expense.
No. If it did, it would completely distort the picture of 2024's actual operating performance.
Yeah.
Instead, that $2.4 million is treated as a direct adjustment to the opening balance of retained earnings in the statement of changes in equity for the earliest period presented.
So if we're showing 2023 as the comparative in our 2024 accounts, that $2.4 million adjustment reduces the retained earnings balance shown as at 1st January 2023 in the CCA.
Correct. It hits the balance WAF, as previously stated, leads to an adjustment for prior period error, and then gives the balance WAF restated. This is the absolute key point examiners look for, distinguishing between correcting a current period issue, its current PL, and correcting a prior period error, adjusts opening equity, restates comparatives.
And the logic is to avoid polluting the current year's results with historical mistakes.
Exactly. You fix the past by adjusting the starting point and restating the comparative figures, ensuring the current PL only reflects current period performance and current period corrections.
Okay, let's try the other example. The impairment error. Say it's 2009, and we discovered that back in 2008, we failed to recognize a $500,000 impairment loss on a non-current asset. So the asset was overstated on the 2008 balance sheet, and the 2008 profit was overstated too.
Right, classic prior period error. The information suggesting impairment was likely available in 2008, but was overlooked or misjudged. So when preparing the 2009 accounts, which will show 2008 as a comparative.
Those 2008 comparative numbers are wrong and need fixing, retrospectively.
Correct. Full retrospective correction is required.
So how does that $500,000 correction flow through the main financial statements presented in 2009?
Okay, let's trace it. First, we need to restate the 2008 comparative figures.
Right. So on the comparative statement of financial position, SFP, for 2008, the carrying amount of that non-current asset needs to be reduced by $500,000.
Yep. Brings the asset value down to what it should have been at the end of 2008.
And concurrently, on the comparative statement of profit or loss, PL, for 2008, we need to show that $500,000 impairment expense that should have been recognized back then.
Correct. Which means the restated profit for 2008 will be $500,000 lower than what was originally reported.
Okay, so SFP and PL comparatives for 2008 are fixed. What about the statement of changes in equity, SOCA, prepared for 2009?
The SOCA is where we tie it all together. That $500,000 reduction in 2008's restated profit needs to be reflected in the equity section. Specifically, the opening balance of retained earnings for the comparative year, which would be the start of 2008 if shown, or reflected in the brought forward balance into 2009, must be adjusted downwards by $500,000.
So similar to the fraud example, the adjustment hits the opening retained earnings balance for the earliest period presented.
Exactly. When the user looks at the 2009 SOCA, they'll see the opening retained earnings as previously stated, then the $500,000 downward adjustment for the prior period error arriving at the restated opening balance. This ensures the starting point for 2009 equity is correct, reflecting the fixed 2008 results.
That walkthrough really highlights the thoroughness required. You're literally reissuing corrected historical figures within the current report. It really reinforces that golden rule. Fixing history, whether it's a better policy or an error, means retrospective. Updating the future means prospective.
That's the absolute core logic of IAS 8. And just to add one more nuance there, sometimes you might have an error in making an estimate.
Ah, how does that work?
Well, say you estimated useful life was 10 years based on good information. 2 years later, circumstances change, you revise it to 12 years. That's a change in estimate perspective. But what if you discovered today that the original 10-year estimate 3 years ago was based on a spreadsheet error, a simple calculation mistake?
Ah, so the original estimate itself was flawed due to an error, not just new information changing things.
Exactly. In that case, it wouldn't be a change in estimate. It would be the correction of a prior period error relating to the original estimation process, and that would require retrospective correction. The nature of why the estimate needs changing new info versus fixing a mistake dictates the treatment.
Okay, this has been a really detailed breakdown. To help everyone listening really lock this in, especially for exam purposes, let's quickly synthesize the rules into that core IAS 8 matrix again. 3 categories, 2 main treatments.
Sounds good. Classification first, treatment second.
Right. Category 1, accounting policies. We're talking about a voluntary change because the new policy is demonstrably better, more relevant, and reliable.
Or a change that's forced on the company by a brand new IFRS standard.
Okay. And the treatment for these policy changes.
Generally retrospective application unless it's truly impracticable. That means restate your comparative PL and SFP figures and adjust the opening balance of retained earnings in the SOCIOR for the earliest period shown. High bar to make the change, intensive work to apply it.
Got it. Category 2, changes in accounting estimates. This is where we revise our judgments, useful life, residual value, bad debt provisions, warranty costs.
And, importantly, includes changing the depreciation method, because that reflects a revised estimate of the pattern of economic benefit consumption.
And the treatment for estimate changes.
Always prospective application, no exceptions. The change hits the PL in the current period and, if relevant, future periods. No restating the past, no adjusting opening balances, just update your forecast going forward.
Simple and clean. Okay. Category 3, prior period errors. Material mistakes discovered from previous years, math errors, oversights, misapplying policies, fraud effects.
And the correction.
Also retrospective correction, just like a voluntary policy change. You have to restate the comparative PL and SFP figures and adjust the opening balance of retained earnings in the SOCIA to fix the historical record.
Perfect. That's the matrix. Policies, voluntary required change, retrospective, estimates, pairs, material, retrospective.
And running alongside all of this is the need for clear disclosure, right? You can't just make these changes silently.
Absolutely not. Transparency is paramount. IAS 8 has significant disclosure requirements. For any retrospective change, policy or error correction, you have to explain in the notes what changed or was corrected, why it was changed, corrected, and the quantitative impact on each financial statement line item affected for the current and all prior periods presented. Users need to understand exactly how the historical numbers were altered.
And for prospective changes and estimates.
You need to disclose the nature and amount of the change if it has a material effect in the current period, or is expected to have a material effect in future periods. For example, changing a useful life significantly would require a disclosure of the impact on current and future depreciation charges.
So putting it all together, what does this mean for someone actually using these financial statements, an investor or analyst?
It means you absolutely cannot take comparative figures at face value without reading the notes, especially if a change or restatement is flagged. If you see a note mentioning a change in policy or a correction of error, dig deep. You have to dig deeper, understand what was changed, and quantify the impact on the historical trend. Was last year's reported profit restated downward significantly because of an error? Did a policy change boost asset values? Without reading those IAS 8 disclosures, you could easily misinterpret the company's performance or position. IAS 8 forces companies to be upfront, which empowers users.
This really does feel like IAS 8 isn't about punishment or just making life difficult. It's fundamentally about maintaining the credibility and usefulness of financial reporting in a dynamic world.
That's exactly it. Getting your head around when you need to look back and fix the past, retrospective, versus when you just need to update the future, prospective. Mastering that distinction is key, not just for exams, but for understanding the very foundation of consistent and reliable financial reporting in practice. #outro.
Well, that was a really comprehensive deep dive into IAS 8. It's definitely one of those standards where understanding the why behind the rules, consistency, comparability, faithful representation, makes the how retrospective versus perspective makes so much more sense.
Absolutely. Hopefully breaking down that core matrix and working through the examples helps everyone listening feel more confident in tackling these issues, whether in an exam or looking at real-world accounts.
We certainly hope so. This deep dive into accounting policies, changes in accounting estimates, and errors is another important step in our journey through key financial reporting standards.
And for those of you using this as part of your study plan, just a reminder that this is part of the ongoing SmartPass financial reporting series. We'll be continuing to explore more IFRS and other financial reporting topics in future sessions.
That's right, so make sure you check out the video description. You'll find links there to useful SmartPass study resources to support your learning.
And don't forget to subscribe to the SmartPass YouTube channel. That way you won't miss out on future deep dives with expert-led exam prep and practical insights.
Definitely do that. Thanks for joining us today for this deep dive into IAS 8. We'll catch you on the next one.